Hey, y'all, welcome to the Texas Blockcast. We have another great episode for you today. I'm excited to have a conversation with Joshua Smeltzer, a tax partner at Gray Reed. He also leads their digital asset practice, blockchain digital asset practice at the firm. And so we're going to talk about tax today. Joshua, thanks for being here. I'm excited to have you on the show.
All right. Thank you for having me. I enjoy it. I enjoy talking about tax. The audience may not enjoy it as much as I do, but it's something that I think everybody needs to know, and hopefully we'll make it as little painful as possible.
It's like doing push-ups, right? If you don't always enjoy doing the push-ups, but you have to do them.
Exactly. Right. And you feel better afterwards.
You feel better afterwards.
So.
Okay, well, so tell me a little bit. Gray Reed was an early mover in the digital asset ecosystem as a law practice. Obviously, you guys have taken a lot of clients in that space, and you've even hosted some events for us at your incredible offices in downtown Dallas. So what caused that early move into this industry? Was it a couple key hires like you and Chris and others that came into the firm with clients, or was it an internal drive or a little bit of both?
So our chief operating officer is actually he's been into crypto and digital assets for a while. Okay. And so he has been mentioning to the firm about getting into the space. But I do think it kind of was triggered by some key hires with that, because when I was hired by the firm about 3.5 years ago, and Chris was hired about a year before me, we brought with us kind of a deeper experience in the space. I also brought clients with me that I had been helping in the space since like 2018. I had a lot of clients that way. And so once we realized that we had a core group of clients that we were already helping, and a core group of knowledge that we already had, it just made sense to open it up so that people knew that we were there to help them with that, with any problems or advice that I need.
And we're finding that there are no shortage of challenges that need the eye of skilled attorneys to look over. But today we're going to talk about tax. And so to level set, if you could give us the base foundation of tax as it relates to Bitcoin and digital assets, from the IRS consumer perspective.
Sure. So when cryptocurrency, started to come onto the scene, it was originally the IRS didn't pay too much attention to it. It was a very small group of people that was using it. It didn't have a very large market share. But as it started to grow and companies like Coinbase started to come to the surface and they realized that there was millions and millions of dollars there, they realized that they couldn't ignore it anymore. The first step that the IRS took was that they needed to know exactly how much cryptocurrency was out there.
Yeah.
Because they wanted to tax it. They wanted to know what people have. And that's a general tax principle. Whenever there's been what they call an accession to wealth, essentially you get some sort of new wealth. The IRS says
they want their cut.
Yeah, they want their cut. And that's just a general principle in tax. Anytime you have something of value, it's usually taxed. And anytime that something of value moves, there's going to be tax consequences with the movement of that. So they wanted to know just exactly how much was out there. And then their next problem is it moving? Because if it's moving, there are going to be tax consequences. So one of the initial things that they did and what started to make headlines was they sent out what was known as a John Doe summons.
I remember that, yeah.
Yes, and a John Doe summons was sent out to Coinbase because it was the largest exchange at the time, and probably the easiest way for them to kind of take a sample of how much was out there and use their analytics to determine. Now, John Doe summons is a curious thing because what the IRS does with the John Doe summons is they go into the court with no opposition, and they ask the court ex parte, which means no opposition and there's no other side. They essentially say, we think that the revenue laws are not being followed. We think that this particular company has information on the people who are not following the Internal Revenue laws, but we don't have the names. So we want to serve a summons to get the names so that we can collect. And what they were specifically looking for was transactions over $10,000 in cryptocurrency. Because the IRS in 2014 had said that whenever you receive cryptocurrency, you treat it as property, which means that it is value to you when you receive it, and then you are taxed on the gain when you either sell or exchange it or do something with it. So essentially, however much it's appreciated, you have to report it and pay the tax on that. And so that's what they were trying to get at, was transactions where $10,000 or more were moving, so that they could determine who owed taxes on there. So there was a big fight. Coinbase didn't want to give up their customers' information, which can be expected to protect privacy. But eventually they did end up having to give thousands of customers' names. Now, since that time, they've issued John Doe summonses to Kraken, to Circle, to SFOX, to a bunch of them. And the Justice Department has put out a press release saying that they are going to continue to use the John Doe summons to collect that information.
And they added it to the personal IRS forms when you file your taxes.
Yes, exactly. So they've added that question as well, which is something, as an individual taxpayer that turns out a 1040, if you've been paying attention, which maybe you haven't, originally it was on a schedule in the back. And then they moved it to the front, and then they kept making it more and more prominent. And now it sits right underneath the person's name, whether or not you've done it. What's interesting is it's changed yet again. So the 2022 question now incorporates the new definition, which is really the only legislation we've kind of seen, tax legislation we've seen yet, is the definition of digital asset was included from the Infrastructure and Jobs Act. They defined digital asset for purposes of brokers reporting it, but they're now using that. Now, that's important because before it used the term cryptocurrency. Now, a digital asset is different than cryptocurrency.
Sure.
Because as we know in the space, NFTs, other things that are there are different than cryptocurrency. So as it currently stands for taxpayers filling out their 2022 returns, pretty much if you have anything that's kept in blockchain digital form, the IRS wants you to check that box, letting them know that you've transferred it. And that's important for a little bit of history. I've also helped many taxpayers with foreign bank account reporting. For a long time, people were keeping money in Swiss bank accounts and not reporting them to the IRS. The IRS has litigated those cases by saying that you willfully failed to report it by not checking a box on a schedule in the back. So if you haven't checked that schedule, they consider it willful. And they've moved that. They've had some problems litigating that because some taxpayers have said, I didn't even know that schedule, or my software didn't bring up that schedule. And I think that's why we've seen that question move to the front of a return, so that that excuse is removed in any future litigation. So that's really what they've been trying to do, is just gather the information that they have. The problem is when they gathered all that information, what they found out was they had a huge problem because they could figure out how much cryptocurrency was out there, and only a very small fraction is actually being reported. And so they've done all kinds of other education plans. They've sent threatening letters to people to kind of make sure that they report it. Individuals, if the best thing you can do is to just report what you have. there, because it's a very easy thing for them to prove that you didn't do it, and it can get real bad real fast if they don't do it. But the problem is there's very little guidance on how to report it, and so it gets kind of confusing for individual taxpayers.
It does. What are your thoughts on these softwares like TaxBit and others that help with forms? Because I've always had trouble with, like, if you've got a brokerage account and, with traditional equities, trying to upload those into TurboTax or send those to your CPA, especially the TurboTax route, can be very frustrating.
Yeah.
Now, whenever I go in there, I'm reporting like my basis and my, gains for say, crypto or Bitcoin or some other digital asset, it gets so complex so fast. And I'm mostly a hodler, right? I've only, made a few sell transactions. It's mostly buy transactions. So it's not like I'm not like a day trader. I've got thousands of transactions.
Yeah.
But the ones that I do have were frustrating. And so have you had any feedback on the softwares that, like TaxBit, that I think they track your basis and your gains across wallets, if I'm not mistaken?
They can, and some, depending on how sophisticated they are, can actually analyze the blockchain itself and give you information. And that's important for some people because if you do most of your trades on an exchange, they're getting better about reporting those and having the information available to you.
But
that
they
you can
don't
print it.
Unfortunately,
But they
it doesn't
do not upload.
Yeah.
So you have to print it out and sit there on
brutal.
yourself and type, right? Your own data entry. But if you have had cryptocurrency for a long time, before the exchanges were kind of as sophisticated as they are, or had the money or personnel in order to keep track of that kind of stuff, sometimes you may have old cryptocurrency that figuring out your basis is impossible without an analysis of the blockchain itself.
Wow. Yeah.
Unless you wrote it down. And so I think for those software programs, they're vital to people who especially have been in the space for a very long time. Because without them, I don't know that you can accurately do it. And the IRS's answer, if you can't, clearly point to what your basis is you can use any reasonable method. And that's a very broad thing.
Yeah.
And what you might consider reasonable may not be reasonable to somebody else.
Yeah.
And so being able to use kind of a mass marketed one, and most of those, I know some of the people at TaxBit and other things like that, right? They have professional accountants and other people who design that in order to kind of give you some backup for the method that you're using in order to calculate what your basis is and then what your gain is and then report it. But definitely those softwares, especially the sophisticated ones that can analyze the blockchain, for the people who, I had one client who inherited a USB of cryptocurrency that from his father, who had bought it years and years ago. And all it had was the keys, but not really a whole lot more information.
So he has no idea.
And without being able to analyze the blockchain, it'd be impossible for him to decide what it is and what he owes.
I guess you could go to a company like Chainalysis and say,
yeah,
hey, what's the history of this?
Yep. And they do the same, right? Yeah. But right, there will be a market for it as more people get into the space. And it's nice to see that some of these software companies are now deciding that there's enough of a market for them to do it. And so as the market grows, the sophistication of those products will also, I think, go up.
Do you have any go-to where you have a client come to you and say, hey, I'm doing this, I have these questions, this question. Oh, by the way, I need to get a software because you're probably helping them on their stuff that's sort of in the past. And they're also asking you, hey, moving forward, how should I do this? Do you recommend any sort of software?
Usually I end up referring them to accountants who work in the space because I don't do the accounting work. But usually what I'll do is I'll explain to them, hey, listen, here's what you need to be able to figure out your basis. The IRS determines it to be a reasonable method. Here are a couple of the reasonable methods that they use. There are software programs out there. And if your current CPA isn't aware of them, I can usually give them the names of those software programs that they can use. But or refer them. Sometimes people just need an accountant that works in the space. And we're starting to see also more accountants who are making a significant portion of their practice digital assets. All of the accountants that I know can kind of functionally work their way through it. But if you end up with something truly complicated, you probably need to find a specialist in that.
So let's just jump up one level of complexity here and talk about transactions.
Okay.
Point of sale transactions for XYZ consumer item. You're scanning a QR code or you're hitting send on a wallet that you've copied and put into your wallet, and you're sending $50 of Bitcoin to purchase, whatever item might be. Let's say it's a jersey or I don't know why I have sports on my mind. So like a soccer ball or jersey or something like that.
Sure.
Or maybe memorabilia, like a signed piece of memorabilia. At this juncture, are we seeing that those transactions are being obviously there is a movement of money. There is a gain or loss that should be reported on that transaction. In my world, we're thinking about de minimis. We got to get this de minimis exemption because it decreases complexity on those kinds of transactions immeasurably, right? If the de minimis exemption is $200, like it is for foreign currencies, that'd be great. But what do you have any clients? And obviously, you can't say who they are, but maybe you can speak about them generally that do a lot of commerce in this space, and how are they working with their customers in these kinds of small transactions?
I don't have a lot of clients who kind of have issues with common day consumer transactions, and I think we're not seeing a whole lot of it, which is unfortunate.
Yeah,
because I
probably
think
because of this.
Yeah, because it's exactly because of that. I mean, you cannot make a purchase of any reasonable size without it having, because everything is reported on a schedule on your tax return, right? So every single transaction, and there's not very many lines on that. So you end up, if you are someone who's a day trader or you have just a normal, think of your credit. I get an annual credit card statement, right, every year of everything, and it has a nice pie chart on the front of everything I spend my money on. But right, think of all those transactions from a year. Imagine if you were trying to use cryptocurrency to make all those transactions. All of that would have to be appended to your tax return and a calculation made each time for what you made. And remember, right, like if you had bought one Bitcoin, well, $50 is not one Bitcoin. So now you have to have the basis for the entire Bitcoin, create a subset of that for the amount that you spend, and then be able to do it. And there are tax advantages to doing it very specific ways. Because you can spend whatever Bitcoin you want, ones that has a high basis or a low basis to minimize the gains, or use losses if you want. The problem is that it is kept the same way that stocks and securities are kept. And so it has all the same complexity of a financial transaction involving stocks and securities to buy a cup of coffee. And I think we absolutely, thankfully, there is federal legislation that's been proposed to try and get a de minimis exception to cryptocurrency so that it can be used in the marketplace. And hopefully we'll get something like that. I think politicians for a while there were focusing on some sort of sweeping legislation that would cover everything.
Yeah. That's just not feasible right now.
The UK tried it, and they thought they had something along those lines, sweeping legislation that way. And I mean, we had one very sweeping bill, but now I think they've broken into pieces, right? They're trying to do legislation to fix the broker definition. They're trying to do this one just for a de minimis exception. I think those have a greater likelihood of passing and will make commerce for the everyday consumer a lot easier. That way, if you do own Bitcoin, it's not just an investment. It can also be useful in commerce.
Now, what about in the worst case scenario that legislation is 10 years away?
Yeah.
De minimis exemptions. Is there a business opportunity for a company with the similar skill sets as, say, maybe a TaxBit to develop a software, like some sort of code that runs on a wallet, like a hot wallet on your phone, that is able to, track what the basis is for those particular sats, if you're using Bitcoin or that particular amount of Ether, and then like log all those in a format that is extractable for a CPA or for like a tax software?
That's a really interesting idea, because essentially those software programs would already have most of your history. And if a person was using the same software the entire time, it would all be there.
Yeah.
And I could see you being able to design a software product that, as long as you uploaded all that to it, it could one, be your service provider for making the payment, but two, it'd be able to run some sort of algorithm to decide what Bitcoin you should sell and when.
Oh yeah, that's even better.
Right?
So it optimizes
It would be able to optimize the payment system.
Yeah. And say, hey,
in
sell
order to
this
do
one
it.
because you have the least amount of gains
Yeah.
on this, or you have these losses on this 0.5 Bitcoin right here because you bought it when Bitcoin was 50K and now it's 25K.
Yeah, exactly. Or when you made one purchase and it caused a gain, you could make another purchase to cause an offsetting loss to equal everything out.
That is brilliant.
So, right, in order to minimize the tax impact for it.
You could just do it to where it all nets out.
Yep.
Not in every situation, because some people bought Bitcoin really early and all of theirs they have huge gains on.
Yes.
But like for the average person that has some gains and some losses,
Yeah.
they could try to net it all out.
They could try and net it all out. And as long as you had them to offset, there shouldn't be any problem with anything going on there.
But then that software would still have to upload a record of those those transactions that netted out to their 1040.
Yeah. Well, essentially, right, like if you're uploading your system, presumably you would end up with partners. Or even the TaxBit software itself may have a payment option with it. They may decide to spin off some sort of company that speaks specifically with their stuff. And so that way, if you use their tax software, it also comes with this payment optimization app or something that would go on there. So I do think there is an opportunity for that kind of stuff. And it speaks to the point that we are still so early in this in this process in figuring out. I always compare it to the internet because that's the easiest thing for me to remember. Because when I started college, I had a very rudimentary email account, Pine, if anyone remembers Pine. It looks like the opening scenes of The Matrix, right? Just with all this kind of stuff there. It wasn't very user-friendly at all. But, and I remember when the internet first came on too, and Dartmouth had a website that you could go to and get information and that kind of stuff on there. And it was very clunky. None of us had any idea the true power that was in there.
Yeah.
And I think the same is true of digital assets and of the blockchain technology. Right now we're seeing these little hints of things that are really interesting and really fun. And it'll be interesting a decade from now what it's finally developed into, and what you're able to do with that. And right, like this type of simple being able to change it will be interesting to see.
So let's take another step up the pyramid
Sure.
of complexity. Two specific situations to query you about. One is a tokenized security, like a piece of real estate that's been tokenized, or
Sure.
maybe some sort of private equity fund or family business or something that's been tokenized. And the secondary trading, the tax implications of the secondary trading of those assets. And the other is this double tax on those that are either staking or mining. So like a Bitcoin miner or someone staking, like the tax, there's some tax complexity in both of those situations. So start with the tokenized security piece. Obviously, it's going to be taxed like other securities, but are there additional complexities because the secondary markets are more frequent? Have you had any experience with?
I think we're just starting to see this,
Right.
and it's an
You got to
interesting.
wait a year, right?
Yeah,
Because a Reg D, you can't actually sell your on a secondary market a year after.
And I mean that's primarily securities. I know just enough securities to get myself in trouble probably, but what I think we're just starting to see this with the tokenization of all kinds of things, right? Not only funding for projects, people are doing capital raises using tokens along those lines. Real estate investments those are being done where you have these tokens, and so it functionally it works the same as you would like a share of stock or an interest in a partnership, and as those interests in the partnership or your stock goes up or down, right, you have gains, and presumably because it is representing a share of something else. You should be able to defer those like you would anything else, and you shouldn't be able to. You shouldn't be taxed on it until it's ultimately sold. That interest is sold.
Sure.
What's curious about these is most of these are done via smart contract, and with those smart contracts, the people who are offering these tokens are building into those smart contracts the equivalent of a kickback. Essentially, whenever an interest is transferred, the party who originally created that interest can get some money back in that transfer. And that has its own tax implications, right? Because value now is being given to this person as a revenue stream that goes through. So they're going to have their own income on that that's going to go. And if you own a part of that partnership, that'll be flowing through to you as well. So it can get real messy real fast because you have all this money moving in all kinds of different directions for essentially the same project that way. But presumably it should work similarly to owning an interest in a partnership or owning an interest in a corporation like a share of stock would. The staking is an interesting question as well because we're moving from this. I think mining made a whole lot more sense for the IRS to be able to say, right, like it's minted. They could use their usual principles of custody and control of something. And once you have that and you have the unfettered ability to spend it, well, now you have income and you deal with that this way. But staking is a little bit different in the way that.
Can I pause for
Sure.
just a second and help me understand? So when, say a miner gets a block reward, 6.25 Bitcoin, and they are then taxed on the fair market value of that at the time of the block reward being transferred. So you pay business income tax on that. Is that?
Yep.
And then say the miner holds on to that for, 6 months, then and that asset appreciates and therefore you have a gain. You're paying, and then you dispose of it, you trade it or you sell it, or something like that 6 months later, and then you pay on that gain.
Mm-hmm.
Is that how all commodities are treated? I mean, I feel like wheat can't be treated that way, or like oil. Is oil and wheat, are other commodities treated that way?
No, and that's part of. I mean, not all commodities are treated that way.
Are there any commodities that are treated that way?
I'm trying to think whether or not there is a point where certain commodities become saleable, right? And you have to pay income on them sometimes if it's not sold anyway.
Okay.
It's saleable. And so it's part of your inventory, and then it factors into some of that.
So like if you were a gold miner and you kept some gold and you were past the point of sellable and the value of gold, that gold appreciates a considerable amount, you could potentially have
gains. So because it goes into your inventory, right? If you're in the business of, selling gold, then at some point it may make it into your inventory, and as part of your inventory, there would be tax consequences along with that. But with the staking, I mean, that is the argument that has been made, and unfortunately, we don't have a decision on it. This was a Jarrett case. Mm-hmm. It was a very small refund suit. So I used to work at the Department of Justice Tax Division. They were on the other side of this. So when you feel that the government owes you money, you sue them to get that money back. And so what the Jarretts had done is they had paid the income tax on their staking rewards. And then they sued the government for a refund of those staking rewards, saying that it should not have been taxable. And the argument there was similar to what you were saying. Essentially, they were saying if we were a baker, you wouldn't tax us on the flour, sugar, and eggs. You wouldn't tax us on the cake even until we sold it, right? If we were a farmer and we were growing apples, you don't tax us on the apples as they grow. You tax us when we sell it. And they felt like that was how the staking reward should be treated as well. Unfortunately for the Jarretts, this only amounted to a few $1,000s.
Yeah, it's negligible.
It was a negligible amount. And so which is fine, you can file that refund suit. And actually it's a decent vehicle because a lot of people file in tax court as opposed to district court because in district court you have to pay the money in first and sue to get it back. But in tax court you don't have to pay anything. But the district court, I think, is a much more favorable venue for some of these issues because some of these are not very tax heavy. They're pragmatic heavy and they're corporate heavy. How is it that we want to tax this economic treatment? And I feel like the district court can sometimes be a better venue for making those economic treatment and corporate arguments. But in order to do that, you have to ante up the money first. But for the Jarretts, that was only a couple of $1,000s. The problem is that the Justice Department decided, for whatever reason, that it wasn't going to contest it. They paid them all their money back.
Yeah.
In lieu of getting a decision. The Jarretts objected and said, no, we want this decision because it's going to be an ongoing problem for us. Every single time we get these rewards, we're going to have this problem. And we can't just keep suing for refund over and over and over and over again. But the court said no. Yeah. It was mooted the minute they no longer had money to refund.
So that they didn't have a standing to continue the case, right?
But it is a decision that I think needs to be made. When does someone truly have value? And is the cryptocurrency mining in any of its different varieties, is there a case where one should not be taxed until the ultimate sale of that, right? And everything just kind of sits in inventory, or if you're in a dealer of cryptocurrency or you treat it some other way, I think we're going to see that. And I feel like 2023 and 2024 are going to be big years for legislation and regulation in this space. The government had to ignored it too long. 2021, we saw a huge adoption by individuals getting into the space, buying cryptocurrency and using it. And then we saw a bunch of kind of fraudulent behavior in the space that caused the government to be concerned exactly for these individual consumers. So I think individual consumer legislation and regulation we're going to start to see a whole lot more of that, because there's going to be inevitably some form of act that's going to be a digital asset consumer protection type bill at the federal level to protect people, and it's going to impose things on the companies or people who deal in this space, and hopefully answer some of these questions so that individuals have a clearer idea of when they do and do not have taxable income.
Yeah. Well, that's important, right? We want the industry to grow. We want commerce to commence, and a clear regulatory framework is essential for those things.
Yep, exactly. And groups like the Texas Blockchain Council and other people who are in the space, they're going to be key to that. One benefit that I think cryptocurrency, digital assets, and blockchain has, as opposed to other assets that have kind of appeared on there, usually when you get like some weird or different financial derivative product, all right, it's brand new, it's not around for a very long time, and the government starts regulating it, making decisions and doing things that way. But digital assets has been around for a very, very long time, that the people who deal with them and the organizations that deal with them are way more knowledgeable than the politicians are about it, because they're learning about it now, because it hasn't been a problem until now. And that is good for the industry, because if the industry can get involved and advocate, they've already kind of had a chance to wrap their mind around these issues, be able to explain them, have large groups of people and constituents behind them that can push for specific results that make sense. Whereas, sometimes if it's just one hedge fund that came up with some unique product, it's just them advocating for it.
Yeah.
But this is a lot bigger than that.
It's broader.
Yeah.
Yeah, and you have a lot of uninterested third parties that are non-conflicted.
Yeah.
Whereas in the hedge fund case, they're extremely, their conflicts of interest are everywhere.
Yep.
So
Very good.
Well, okay, so finish us out with a couple thoughts that you think everybody should know about tax treatment and what consumers should be thinking about, and then also let them know where they can find you on the internet or at Gray Reed.
So I think the key thing that individuals should think about right now is, one, if you have unreported cryptocurrency, you need to deal with it. You need to get with your accountant. You need to get with somebody and get it reported. There is an IRS voluntary disclosure program that you can do, and I think some people are afraid because they've done something. They now know that they should have reported it, but they didn't think they had to in the past. There is a voluntary disclosure program that you can go through, which prevents criminal exposure and a whole bunch of other things that you just don't want to worry about it. I just know from speaking with the people that I still know in the government and seeing them on panels at conferences, it's only a matter of time. They have so many analytics. They hire their own vendors to explore the blockchain that eventually they're going to find these big transactions. And it's going to be way worse if you disclose it after they find you as opposed to before. So you should definitely do that. The other thing is be very cognizant of your information and who you're giving it to in these spaces. Because, one, the Justice Department is seeking after these things, and you'll want to know your privacy protections within the agreements that you have with exchanges or other brokers that you deal with. We saw this in one of the few decisions that we have in the cryptocurrency space came out during the bankruptcies. And during that bankruptcy, the terms and conditions of people's accounts kind of hit home this not your keys, not your cryptocurrency, right? Essentially, it said that if you had turned your cryptocurrency over to a wallet that was maintained by the exchange owned your cryptocurrency because it was in that wallet. So you need to know those conditions. We all click past them, but it's very important to read them because it is the custody and it is the ownership of your account now, or or find an alternative, some sort of self-custody wallet, or some form of cold storage that you keep your keys in. But those terms and conditions are very, very key, and they'll be key for you from a tax perspective as well, because the last thing you want to do is have paid income tax on something that you now, based on a bankruptcy decision, no longer owe and have to ask for the government for the money back. So be very careful with those as well. And then the last thing I'll leave everybody with is not to be afraid of this space, because while it can seem confusing, currently the way that it's set out is it's taxed as property, and there's a lot of decisions out there on property. And so there is a way for whatever it is that you want to invest in or do as an individual consumer, there's a way to do it, and there's a way to do it that will not have terrible tax impacts on you. Mm-hmm. If you want to invest in a specific digital asset project or a company that has an interesting idea with using blockchain technology or Bitcoin mining or some other type of cryptocurrency project, you can invest in that and not be afraid of it being cryptocurrency. There is a safe way to do it. And the last thing that I would want people to see is to be scared off of an investment because of some unknown tax consequence or other regulation. This will all get itself worked out, but if you're interested in something in the sphere, don't let taxes scare you away from it.
That's a great way to end. Where can people find you?
Okay, so you can find me on the website, grayreed.com. My bio's there. It has all my information there. We also have a blog on there that has a lot of cryptocurrency posts as well, especially for individual investors on how your collectibles are taxed if you happen to own any NFT collectibles and that kind of stuff. I'm also on Twitter at JD Smeltzer. I do that, LinkedIn as well. All right.
Perfect. Thanks, Joshua. Thanks for coming on the show.
Thank you. Okay.